All right, we are back. Episode 2. You need to be here. If you've never traded before, you need to see this. And what I'm about to say seems really simple, and it's because it is, bro. People overcomplicate trading. The essence of trading is buying low and selling high. So that's what we're about to get into right now, is just reading the chart and understanding what is going on. Profitable traders' greatest tool is pattern recognition. Does that ring any bells? Does anybody know what type of patterns I might be recognizing? We must be able to identify patterns when they manifest. Things are always happening, but that doesn't necessarily mean a pattern is at play, right? There it is. I got it. When the patterns do manifest, we need to be able to key in, pick up on it, and contextualize why it's occurring, because patterns exist because a similar string of events are occurring. Really, when it comes to at least small cap stocks, it's a lot of similar people putting their money up, taking it out, putting their money up, taking it out. The stock market is a reflection of human psychology, and human psychology is finite. Unless you're Kanye, bro, you're typically gonna do the same things. And when you do change, it's not something that hasn't been done before. A great quote from the Bible: there is nothing new under the sun. The only time I use options is when I know a price move is coming and want to scalp the stock. And scalping, if you're unfamiliar, is a short-term strategy focused on making small, quick profits from minor price movements. And because options are leveraged, we are gonna make bands on these price moves. Instead of just holding from 150 to 180, we doubled our money by twerking on the chart with it. Pause. I'm placing bets on where the stock is going based on history and current events. Hitting the money line or the spread on a basketball game can be difficult, but imagine if you only had to bet that the score 30 or above was going to show up on the scoreboard at some point during the game. That is what we're doing, bro. Let's try some questions. Number 1, do you see any pattern here? Yes, we see a pattern here. When this company, which it's Intel, goes down to 20, and it doesn't go below 20 very often, at some point in the next month or two, it goes up to 25. Every single time. We were at 35, we dropped to about 20, and then in 2 months, we went up to 25, and then in another 2 months, we went back down to 20, and then in another month, we went up to 25, and we went down, and then the same month, we went back up, and we went down. And if you look at Intel right now, it is literally $25. Whoa. If we want to profit from this stock going down from $25 to $20, what kind of option would we use? We grab a put. You're a genius, bro. Puts are used when you think the stock is going down. Which put would revalue more when the stock drops from $25 to $20? Think about it. $25 to $20. What's a more valuable sell point? 24 or 10? I hope you got this right, bro. The $24 put would revalue more because it is in the money. Just to reinforce, we're all about reinforcement here. Positive vibes and reinforcement. Which put would revalue more when the stock drops from $25 to $20? A $100 put or a $20 put? It's kind of a trick question, is it? They're both in the money, so it's not as simple as the last one. A $100 put because it is deeper in the money. Let's use this chart from above. Betting strictly on patterns is kind of akin to gambling, unless you know the context of why things are happening. So this is what we need to get you guys to understand. You don't need to understand when to click the buttons. You need to understand what makes people click the buttons. This is what I call market sense, and this is what we are going to get into, and this is going to be honestly what blows me up, God willing. Let's do a few more questions to reinforce the logic. What kind of option would you use if you knew this stock was going up? So let's say we're right here at the end of July, and we think this is going to $40. What kind of option would we grab? We would grab a call. A call is what you use when you think the stock is going up. Which call would revalue more when the stock goes from $12 to $20? A $100 call or a $20 call? The $20 call would revalue more because it is in the money. In other words, it is more advantageous to buy a stock at $20 than it is at $100, especially when the stock's at 20, bro. Come on. Now that you understand the logic of options trading, we can get into some terminology. And so you want to know what people are talking about when they throw out these buzzwords. Insider investors are members of the company owning shares of their own company. Institutional investors are hedge funds, VCs, Wall Street in general, banks. Institutional investors and insider investors are kind of synonymous. Retail is us. Anybody trading that is not doing this as institutional professional. The name of the game is front-running retail. The name of the game is front-running me. The name of the game is front-running your dad. And it's very easy because retail is retarded. Okay, retail always FOMOs, retail always buys the top. Retail is so reactive, and yes, although we are retail, we're a little bit better than retail. Stock charts have these things called resistance points. A resistance point is like a pseudo mental block. They're a product of lack of evidence and human psychology. We make milestones in our head all the time. Once I get to 1 mil, once I get to 100K. Resistance points are literally just these arbitrary numbers that humans have in their head where they're like, something else has to happen to push us above this. You're like, once I get to 1 mil, I'm switching up. Don't switch up ever. That's fucked up. But hopefully you're getting what I'm saying. So for example, a stock will trade between $20 and $25 for 3 months and never go above 25 and never go under 20. That $20 is a support point or a resistance point. It's the same thing. And $25 is a ceiling, another resistance point. And the reason both of those exist is because when the stock gets down to 20, everybody in the market goes, bro, this is such a great deal. This company is worth way more than $20 per share. I'm going to win if I buy here. And every time it gets to 25, everybody goes, there's not enough evidence that this is going to go higher, so I'm going to take profit. That is why resistance points exist. The bottom is called the floor, the top is the ceiling, and then you have support levels. And typically it takes bad news or a big sell-off to break those support levels. So that's kind of a good indicator that things are happening. Like if Intel drops below $20, it's because they just put out terrible news. If Intel goes above $25, it's because they got great news, like the United States government is enforcing Intel upon everybody. These resistance points are often tested, and breaking through or getting rejected is an indicator that the market is either ready or not, and you can use this as a signal to buy or take profit. So in the Intel example, if Intel's at 25 and you think that the United States government's about to send them a care package, you might hold. But if the news doesn't move it above like $25 and some change, you might sell because you want to take profits. Remember, you never lose taking profits. The floor, this is the lowest share price a company will fall to. Obviously, if they go bankrupt, it is zero. The floor is a major support line, and it is a culmination of insiders, institutions, and retail owning shares they're not willing to sell. When a stock falls to its floor, this price point is ideal to buy around, but it is rare. Oftentimes when the floor does come in on a stock, there will be an immediate buy up, and that is called a dead cat's bounce. Now, how do people know or how do people speculate that it's a deal? Intrinsic value is one of those statistics that is analyzed in order to come to this conclusion in the zeitgeist that this is the floor. And intrinsic value is the truest, most pragmatic valuation of a company and its earnings at its current state. Sometimes a stock will trade below its intrinsic value because people are bearish on its future. An example of this, Blockbuster being down below its intrinsic value at the time because the market foresees it going out of business once streaming services start spawning. Now we're going to start getting into narratives, and narratives run the market. A lot of people think earnings run the market. No, narratives run the market, and if you don't believe me, go look at the S&P 500 right now and look at almost every single company trading for millions of dollars more than what they're actually worth. And it's because people think companies like Tesla are the future. They think they're too big to fail. Sometimes a stock will trade far above its intrinsic value because people are bullish on its future. We see this a lot in tech. Like I was talking about, Tesla trading at 170 times their earnings because people believe Tesla has proven it will grow bigger and actualize into even greater returns. This 170x ratio is called the price to earnings ratio, and it's just written as the number, the multiple. PE ratio, price to earnings ratio, is a helpful statistic. It's the current share price compared to the earnings a company nets annually. In the US economy, big companies are constantly marketing and trying to build hype. They release earnings reports 4 times a year. Earnings reports are a fun time to trade. This is a great moment to just speculate on something and get a quick trade off. I'll give you an example just briefly. If you took a company like SoundHound. SoundHound is an AI voice assistant company. If you knew or you read from online or you just had evidence that SoundHound had struck some big deals before they announced their earnings that quarter, you could buy a call or just buy common shares 3 days before earnings. And then when earnings come in and they beat, it's going to go up. People are going to FOMO buy, or people are just going to get bullish. You can sell the day of earnings or the next day after earnings and take a great profit just off of having this market sense and doing some research and figuring out company health. Some people, keyword some people like Warren Buffett, who say one thing and then do something else, would say that all of trading and investing revolves around earnings. I've found that there is diminishing returns when you're focusing on earnings because the market is so hype based. And so a lot of times with companies like Tesla, they'll beat earnings, but it was already priced in. The market was already receiving all this news and they already kind of knew the ballpark of where Tesla's earnings were gonna be. Or there's some nuance for why they fell short, but it doesn't affect the long term. And so a lot of people don't give a shit. And so the stock might go down a little bit on a good earnings report, but it's because people have it priced in. There's only a small criteria of stats that matter on earnings reports. You need to know all of them so you know what you're interfacing with when you do look at these numbers, because you need to know how the retail market is going to react to these statistics. Revenue is the company's sales. Profit is the company's net income or total earnings after every expense, including taxes. Year-over-year growth, this is a big one, compares the current results for the quarter to last year's quarter. A lot of people really dick ride year-over-year growth. Earnings per share, or EPS, is the profit divided by the amount of shares. It's typically like a decimal. It'll be positive, and like I was saying, in the S&P 500, a lot of it will be negative. But hopefully what we want to see, or what people want to see, is that negative number slowly rising up and becoming positive. Guidance is the company's forecast for the next earnings report. Guidance and earnings per share are important. I would say guidance is more important because that is a company basically trying to tell people where they're going. And sometimes they're just capping, bro. I'm not gonna lie. This is why you need to be able to do research and have discernment for these things. Like I was saying, the market doesn't always move on earnings beats or shortcomings, and it's because a lot of it is already priced in. But it's worth noting that you could see sell-offs or buy-ups here. Some people specifically only trade earnings, and some people don't even touch it because it's speculative. Year-over-year growth, EPS, and guidance are the big three, especially right now because we are in a bubble and a lot of big companies are not profitable. This is the point we're gonna go into in the next videos when we get into the fun stuff. There's a lot going on in the world. The social engineers, the WEF, the Zionists, oh shit. He started already. Now, you may be wondering, okay, I get why a stock goes up and I get why it goes down, but how do I get started making these picks? And this is where it gets fun. I'm gonna give you an edge. An edge is basically a filter that we put on the market, and we only operate within this filter. So some people's edge is things like a company going down 40% in a week. Some people's edge is robotics companies. Everybody's got a different edge. At some point you'll find your edge, but I'm gonna give you the most goated edge ever. I actually have who work for huge institutional firms, or I don't want to say huge, and my edge is vindicated by what they do. The things that I focus on that we're going to get into in the next video, they realized, hey, we make a lot of money doing it this way, my way, and we should really lock in and focus on this and build upon it. So stick around for the next video. This was a shorter one. Subscribe, like the video, drop any comments, any questions. You can hit me up on anything. And my Discord, which is completely free for life, is in the description. Christ is King. I will catch y'all in the next video. God bless.